Sorry, I don't mind people sitting here.
Yeah, it feels like they're actually here.
It's important to leave before you walk.
Yeah, it's like
Are we usually plugged in, or we don't need it?
Yeah, it's like fully charged. It lasts for like at least like 2-3 hours, so it's good.
Okay.
Yeah.
All right.
Okay, so I like to join. Are you waiting for a sheet? This isn't mine.
All right. If everyone's please take their seats, we'll go ahead and get started. All right. Once you guys finish signing in, can you please pass the sign-in sheets around? I'm pretty sure we have more than 7 people here. All right. So thank you everyone for coming. We really appreciate it. This is going to be our last meeting of the semester. Thank you everyone tuning in online, World Campus students, interested alumni. Again, if any of you guys have any questions, email jqm5698@psu.edu, and I'll make sure your questions get asked. All right, so we'll go ahead and get started. Not too many announcements this meeting because it's our last meeting, so not a whole lot is going to still happen. However, we do have one more big event after this meeting, and that is our holiday party. I know you're probably getting sick of hearing me talk about it, but this is going to be at Dr. Philbeck's house right here. We pulled up at 4869 Thoroughbred Loop, and it's going to be catered by Moe's. So if you'd like to come, we'd love to have you. It's going to be just a fun time, very relaxing, way for us to blow off some steam before finals week, and to say goodbye to everyone. So if you're interested in coming, the prices are $4 if you are a member in good standing. That means if you are a member that has actually paid your dues. So $4 for members, it's $10 if you are not a member of the FMA that has paid their dues. To sign up, we've got a sign-up sheet going around. Money has to be given to myself, Eric, or Natalie. And we'll go ahead and initial that you paid and confirm everything. So that's all. It's going to be a fun time. It starts at 6 p.m. December 10th. So that's next Thursday, not tomorrow, but the week after tomorrow. All right. Does anyone have any questions about that?
You can't just walk up to us randomly and give us money. We're just collecting money today.
Today, we'll make sure that I'm available here Friday for dues. Or some sort of stuff. Would you mind?
If you want to have people, they can drop it off in an envelope under my door. So we'll have other people like that way as well. When do you need? When's the last day you need to have account for? Days before?
I need to have everything in by, we'll say, Monday, close of business, so 5 p.m. Monday.
Okay.
Make sure that you have your money in and that you're
So
signed
if you don't have it now, you can put it in the envelope and slide it around the door. You can hand it to one of the secretaries and ask them to put it in my box, but make sure your name is on it. So.
All right. That's actually my only announcement today. I know, it's weird. It's going to be our very last meeting for our current officer team. The incoming officer team under Max is going to be taking over in January with some great events that I've heard them talking about earlier. Without any further ado, I'd like to introduce Brian Conway, who's going to be coming to talk to us. Or he already has come to talk to us. I'm here. He's here. He came all the way from Pittsburgh to tell us about some opportunities and challenges within investment management. So if you could please give Brian your attention. Thank you.
Thank you for having me. Dr. Philbeck, thank you very much for inviting me. And the FMA, I really appreciate the opportunity. This is actually the first time outside of a classroom, my classes, that I've actually had to speak to a group so large. So be kind, please. Don't too much at me. I've given some presentations to some big groups, but usually on very specific investment topics that relate to their portfolios. So I'm going a little bit more broad here. So if you have any questions, I know everybody always says this, but if you have any questions, raise your hand or just shout it out. Don't raise your hand. This isn't a class. Just shout it out, stop me, and let's have a conversation. If you want to challenge anything I say, bring it on. We can have a discussion. So opportunities and challenges within investment management. So let me go a little bit into my background first. As I'm sure you guys know, I am a Penn State Behrend graduate. I graduated a very long time ago in 2003 with a finance major and economics minor. I'm in that picture. That is the club lacrosse team from 1999. I believe that's fall of 99, based on the people that are in it. I'm number 10 on the far left-hand side. So I think that was actually the first year that Behrend had a club lacrosse team, so we were some of the first people to start it. After graduating from Behrend, if you're from Pittsburgh and you're familiar with the Riverboat Company, I was an accounting associate at the Gateway Clipper, really in the cash room, dealt with some of the daily transactions, and did some of the ledgers. That was a pretty temporary. I went from there to Mellon Bank for probably about, I have 2 years on there, 03 to 04. It was really like 4 months that spanned those 2 years as a temporary associate. At that point, I wasn't sure if that job was going to be permanent. There was no guarantee it was going to be permanent. So I started looking outside of Pittsburgh for work. And that is when I joined on with Cambridge Associates, the investment consulting firm, institutional investment consulting firm. They have offices globally, but in the U.S., Boston, D.C., Menlo Park, California, outside of San Francisco. Right now, they're also in Australia, London, a couple other global cities. I think somewhere in the Middle East. I think Dubai. I was there for about 2 years and left there as a senior investment performance analyst. So there I did performance measurement. So doing all the calculations, the data collection calculations for all the endowments. So any endowment from 50 million in assets up to $6 billion in assets. So I think the Mellon Foundations, the Heinz Foundations, things like that. And then universities as well. From there, stayed in the DC area, went to Lynx Investment Advisory from 06 to 2013. There I started actually doing performance and then worked my way up to a research analyst and consultant. So we worked with some institutional accounts, high net worth individuals, and was there for a handful of years. In 2013, I completed my MBA at the University of Maryland. So every time Penn State and Maryland play, I pretend to be torn by who I want to actually win, just for my friends down there in the DC area. And that was done part-time, so I was working at Lynx while I was completing my MBA at night. And then in 2013, I left Lynx and left DC and came back to Pittsburgh. And I'm currently a senior research analyst at Grand Street Asset Management in Pittsburgh. Grand Street, just a quick background on Grand Street, just to give you some introduction, was founded in the early 1990s. I believe 93 is the inception date by Michael Evans. It's sort of funny, if you're familiar with the investment space in Pittsburgh, a lot of the old firms in Pittsburgh that have been around 20 years or so, all of the founders came out of the same institutional firm, C.S. McKee. Fagrasso came from there. Michael Evans came from there. I think Mullenkamp, who's a mutual fund, he came from there as well, among others that I know I'm forgetting. I think Bill Few. Grant Street is a registered investment advisor. I'll go into that in a little bit more detail and some of the differences between an RIA and a broker or a hybrid. We have 11 full-time employees, 11 and a half, really, but I'll say 11 here with 6 investment professionals. That's 6 of us that are working with the clients directly or doing research as I am. We have over 150 family or client relationships. Across that, though, we have probably over 900 individual accounts that we manage. So some families might have 10 portfolios that we manage on their behalf. Others might just have 1 or 2 very large portfolios. We have about $425 million in assets under management, and that is all discretionary assets. So we have full authority over making changes to their portfolio. Stepping back a minute, Lynx, it was non-discretionary, so we had to get them to approve any change we made to anything we did in the portfolio. So if we wanted to switch out a mutual fund for another mutual fund, we would have to have that in writing that they approved it. At Grand Street, we don't have to do that. We can make that change for them. We take a team-based collaborative approach to investment management. What that means is every portfolio, every relationship has at least 2 people working on it. So if somebody's out, somebody's sick, somebody gets hit by a bus, there's somebody that's there to back them up and knows the client and is able to work with the family and most likely has met them as well. The collaborative approach, we do work very closely with our clients' accountants, with any CPA they have, any estate work, any lawyers that they might have. We work very closely with them. Because I'll talk about it a little bit later, but that's a trend that's definitely going on in the industry that companies, if you want to be successful, have to deal with and have to approach wisely. You can't just give investment advice anymore. You have to be the complete package. You have to almost be more a large-scale CFP shop for clients now in this space, in the investment management space. And each client relationship begins with a fact-finding meeting. We start out by asking, okay, who are you? That's the first question. What is your goal? What's your targets? How much risk can you take? What do you want this money for? Who's your family? Is this money going to be passed down to your kids, or do you want to give it to your cat? We need to know these types of things so we can structure their portfolio and the relationship appropriately. And we write up a strategy letter for every client that really just highlights those things and then goes into the investment management side. So what is an RIA? RIA, Registered Investment Advisor. Really the big thing here is, I tried to highlight this in here, but it wouldn't let me. I haven't used PowerPoint in a little while, so I don't have the presentation. So it's fiduciary. That's the key word here. We have to act on our client's behalf. That's the most important thing. That's the most important distinguishing characteristic between a broker versus a registered investment advisor. We are held to a higher standard where it's not the suitability standard, it's the fiduciary standard. I'm going to get into some of that as well in a little bit. But we are registered with the SEC. We do have SEC audits. They don't audit very often. They don't have the staff or the money to do so. I think the last time our firm was audited, I've said this, they're probably going to watch this and be there tomorrow. It's been a couple of years. I was at Lynx for about 6 years, or almost 7, and we had one SEC audit in that entire time. So that's something I've heard is going to change and will change over time. But that's just a quick review of what an RIA is. There's a big industry push, especially by Schwab, the largest. It's the 800-pound gorilla in the custodian space. RIA stands for you, just giving investors and any brokers that want to become an RIA information on what it is, how to do so, and really what can be expected of you going forward. So I touched on this. I'll talk about it in more detail now. Fiduciary versus suitability. So the fiduciary standard is embedded in the Investment Advisors Act of 1940. As I said, we are registered with the SEC, and the SEC does hold us to a fiduciary standard. We have to put our clients' interests above our own. If we have 2 relatively identical funds that we're offering to a client, or even ETFs, and one of them has a lower fee, we are obligated under our fiduciary standard to give the lower fee investment option to the clients. That is a standard that we are held to. We do have to disclose any potential conflicts of interest. We can have them, but you have to actually disclose them in your ADV and any other documents that you provide to the SEC. We have to disclose all of our fees. Nothing can be hidden. And we also have increased due diligence standards. Everything we do, everything I do in my position as an investment analyst is documented and recorded. I had to actually have this presentation reviewed by my compliance officer before I came and spoke tonight. So if he's watching, hopefully I'm doing a good job. The suitability standard is under FINRA, so the Financial Industry Regulatory Authority. This is what brokers, broker-dealers are required to follow. Suitability is you reasonably believe that any recommendation made to clients are suitable in terms of their financial needs, objectives, and unique circumstances. What you didn't hear there is lowest fee option. What you didn't hear there is disclosure of conflicts of interest or disclosure of fees. I am biased. I say that because I work in an RIA. I would try not to be as I'm describing this, but the biggest thing, they're not required to disclose conflicts, not required to put investors in the lowest fee product. A lot of times what you'll see in this case, there are within mutual funds, there are front-end loads up to 5%. That goes to the broker. There are trailing 12b1 fees, which are expense ratios that are embedded into the total funds expense ratio. Typically, they're 25 basis points. They go to brokers as well. That's always something, whenever you're an investor, you want to ask about the fees, about how somebody's getting paid, what are all the different ways they're getting paid. Those are, unless you look in the documents, those can be hidden. So that's something to be aware of. And as I said, they're under the suitability standard. You're not required to disclose your compensation. I'll dive into some of this a little bit more with potential changes that the Department of Labor is working on, as well as the SEC, because they're dealing with this issue right now, fiduciary versus suitability. And there is a trend to go towards fiduciary and away from suitability for all investment advice. So whether you work at a broker, a broker-dealer, or you work in an RIA or a hybrid, within possibly the next 12 to 18 months, you will be required to follow the fiduciary standard. So I'm sure you guys have you guys have a great system here. So, great finance department. But this is something I was talking to my colleague before I came up and I was putting this slide presentation together. And, really the question came up, her and I were talking. She's a finance major, so on a CFA. She said, when I graduated, I didn't know what I could do with a degree in finance and all the different options that were available to me. If I would have known this, it would have been a very big benefit. So I'm not going to touch on from this side all the way over because I don't know anything about it. I just know the companies, I know some names, I know some positions that you might be able to do, but the corporate side and the consulting side, that's not where I've spent my career. My career has been spent on the investment side. So I will talk about the two a little bit here. So investments, the way I view it, you can either go into the sales side of investments or the analytics side, or somewhere in between. There is a between area there. But when you think about, the opportunities in sales, you think insurance, maybe independent broker-dealers or wirehouses, so your Merrill Lynch's, your Morgan Stanley's. You think, Edward Jones. Or you could be a mutual fund. You could work in a mutual fund. You could be in sales at the mutual fund instead of on the analytics side. See, because a mutual fund company, you can actually be in both. You could be either in the analytics side where you're researching the underlying companies that are going into the mutual funds, or you're on the sales side of it where you're either at the sales desk, you're at the 1-800 number answering client questions. So touch on those a little bit. Within insurance, a lot of the positions that are in sales are commission-based. So there may be a base salary, there may not be, but it depends on, it is truly a sales position, how good you are at selling product to potential investors, potential clients. Within the independent broker-dealer and wirehouses, typically there is some sort of a base commission as you start out. And I'm going to go into some challenges that a lot of the brokers are going to be facing and are facing right now from some firsthand knowledge that I've learned from some very close friends and former colleagues who are in those positions. So it's a combination of base salary plus commission on any sales. And those commissions go back to the front-end loads that you receive from selling a mutual fund, or the 12b1 fees that are the trailing fees you can collect on an annual basis if those funds continue to be held. As far as a mutual fund goes, you could, if you take the sales route of the mutual fund, chances are you'd be put on the help desk, so you'd be answering individual client questions in a 1-800 number. From there, you could become go to phone sales, where you're actually calling people, trying to encourage them to buy the funds. You could then go to be an internal wholesaler or an external wholesaler. Those are the people that I deal with every day at the mutual funds, the wholesalers. So what they do, most structures now within mutual funds are, if you're in the sales side, we meet face-to-face with the external wholesalers. So they come to our office, they have information about the mutual funds, about the products. They bring us, if the PMs are traveling, if the portfolio managers are traveling with them, they'll come to our office directly. Some of the internal wholesalers will be our internal point of contact. So if we can't get a hold of the external for whatever reason, if they're traveling to meetings, the internal wholesaler, we can contact them and get the same information, essentially. If they stay in a home office, the external wholesalers are traveling, I would say 3 out of 4 weeks a month, and they usually have regions. Most of our wholesalers that we work with at the big mutual fund companies, they might have a region that's the Mid-Atlantic. They might be Pennsylvania, Maryland, Virginia, DC. We know some guys that go from Chicago to Philadelphia, and that whole swath of land there, that's all their territory. So they're calling on guys like me who sometimes pick up their calls, sometimes don't, who sometimes answer emails, sometimes don't, trying to get us to talk to them about the mutual funds and get in front of us so that whenever we have a search for a mutual fund or a need in a client portfolio, we'll think about their fund. We'll think about what they have to offer. That's how we are introduced to a lot of mutual funds, and a lot of investment funds like that are from the wholesalers that come through. We keep a running list of everybody that we meet with, their best ideas, so we know, so we can look back if we're doing a search. And I'll talk about that in a little bit, the searches that we do. Not every fund fits cleanly into a Morningstar search. If you use Morningstar Direct, and I think you guys have the certification for Morningstar Direct here. If you do a search in Morningstar, it's not always clean. Right now, I'm working on a long-short search for long-short equity funds. I want somebody that doesn't short ETFs. I want all individual securities, and I want them to be able to generate alpha. I can't screen for that. So I need to have a list already in my head of who I want to talk to from people that have come through and told me about their strategy and their fund and how they do it. On the analytics side, there are a lot of different jobs you can do. Trading, I did just hear, I put trading in here, and then I just heard, I think, yesterday or today that I believe it's one of the big investment banks is cutting at least half or a couple hundred people from their trading desk. That might not be the best position to consider right now if you're looking at trading. And that's fixed income trading. And that's a whole other issue. I don't know if you guys have talked about that, but the supply of bonds at dealers is at an all-time low. So there's concern about liquidity in the bond market. That's another subject, but the trading desks aren't making as much money as they used to. They're not as profitable as they used to be for the big banks, so they're cutting those divisions or some of that staff. You could be in compliance. This is one I think is one of the fastest growing sub-industries within the financial world, more so probably in the banks than in the large fund companies, but I think they're there as well. With all the increased regulation, the need for compliance professionals is increasing by the day. I think last year was one of the strongest years for compliance job growth in at least the past decade or so. And I think that will continue as regulations increase. You have Basel III, you have Dodd-Frank, you have other issues with the Department of Labor and SEC that we'll cover in a little bit. You can go and become an investment analyst. That's not something you necessarily just become. I've sort of grown into that role, but that's a role under the analytics side of investments. And I'll talk a little bit more about the investment analyst, what I do on a daily basis, or sort of what my role is and the expectations are for somebody that's a generalist. So as a generalist, I cover everything. I have to know about everything that somebody might potentially ask. So you have to have a very, very wide knowledge base. You don't necessarily have to go very deep in every single subject, but you have to at least be able to understand it and be able to talk about it. And then there's portfolio management. Again, that's a role that you would grow into. That's not a role you just start out at as a portfolio manager. Also, and actually, I take a step back. On the investment analyst side, that's also analysts at the fund companies that are doing the individual stock research, that are picking the names that go into the mutual funds, or into the ETFs, or into the hedge funds, or the LPs, or the private equity deals. There's a lot that goes into that analyst position. And portfolio management, the the men and women that are actually running the portfolios and running the money, making the final decisions, deciding which stocks or bonds make it into the portfolios. And the interesting thing, we've come across a lot of teams, a lot of fund companies that we work with that you don't necessarily move up into a portfolio manager role. You can be a career analyst. You never have to become a portfolio manager. If you like digging into the financials, if you like, listening to the conference calls and really working with the management of these companies, and you get to know them inside and out, you're not forced to become a portfolio manager. You can stay as an analyst. And from what we're told, because one of the things we ask all of our teams is, how is everybody compensated? Analysts make just as much as portfolio managers at some firms. The portfolio managers get the name recognition. The analysts are the ones doing the backbone work. So it's something to keep in mind as you go on your careers. Bless you. Any questions at this point? I realize I've been talking for a little while, and possibly a little fast. So, any questions? Okay. Who's here for the free pizza? Or the extra credit? I heard that's being passed out too. No. Okay. So, role of an investment analyst. So, as I said, I'm a generalist analyst. I have to know a little bit about everything. So, some of the areas that I focus on and that I look at on a daily basis. I was looking at information today and got a little concerned about one of our portfolio investments because I don't know if you've noticed or seen this, but the front end of the Treasury yield curve has gone up, call it 1,900%. If you go from 0 to 19 basis points, and the back end of the curve has stayed flat, so the market is starting to anticipate the Fed is going to increase rates at this next meeting. LIBOR right now is up to 42 basis points. That's the highest it's been in over a year, and it just went parabolic. That concerns me. Those are the types of things I look at. That I probably look at on a weekly basis, and that's part of my macroeconomic research. So some of the things I have to know and I have to be aware of, monetary policy. That's a lot of fun right now, especially with some of our investments that we're hedging currency. So being able to understand how the divergent monetary policy could impact not only interest rates, but the currency is very important. Economic growth, there is none, that's easy. Geopolitical concerns, that's been a bigger concern of mine. One of the last investment committee meetings we have one every week, every Monday morning. I asked our team to come back and say, what are the areas that concern you most going forward as we go into the end of the year? Doesn't matter what it is. It can be geopolitical, it can be company specific, it can be fund specific. Geopolitical is really one of my biggest concerns. After Paris, after Lebanon, after Mali, I would have expected the market to react more than it did, especially after Paris. I was a little surprised it didn't. After everything going on in the Middle East with Russia and Turkey, everything is sort of on edge. We don't invest for that, or we don't invest to protect against that, but it's something we have to be aware of because it can impact very specific areas of our portfolios. Do microeconomic research. So the GE Synchrony tender offer. We don't invest in individual securities. We mostly do mutual funds and ETFs, but some of our clients do bring us individual stocks, and we will continue to hold them, especially if there is a large allocation. We'll try to slowly bring it down. If they have a very large capital gain, we're tax aware, so we will not sell it automatically for them. We did work on that to decide whether or not our clients should participate in the Synchrony offer. For anybody that might not know, GE was going to spin out Synchrony. That's the historical financing arm of the appliance division of GE. It was founded in the Great Depression. Synchrony was already a publicly traded company, but GE owned 85% of Synchrony. What they were doing was offering a swap where they were going to retire GE shares and give you Synchrony shares in its place at a fairly attractive offer. for every $100 of GE that you tendered, you would get $107.53 worth of Synchrony stock. We decided to take that bid. We like the opportunity that Synchrony has going forward, but we also still like GE. We're still holding GE. We only put in a tender of about 25 to 30% of our GE shares. However, we only got a third of that because it was oversubscribed by 3 times. So they retired 785 million shares of GE. They had over 2.2 billion shares tendered. The investors wanted to tender in this deal. So we got a third of what we wanted. But we like that deal. Apple valuation, this is something I did earlier in the year. Some of our clients hold very, very large allocations to Apple stock outside of the mutual funds. Every mutual fund owns Apple because we were told by a manager, a large cap growth manager, that, well, we have to hold it because it's such a large allocation in the benchmark. So if we don't, it's a business risk. So we almost sold them immediately after they said that comment because you don't invest like that. But our clients also own some Apple. So earlier in the year, I did some work on it. I came up with a valuation based on free cash flow of about $130 a share, and that was with 10% revenue growth over the next 5 years after 23% revenue growth this year. That was fairly weak. The stock at that point was trading at 133. I had a value of 130. I recommended we sell it or at least put some options on to protect our clients' positions. Right now, I looked before we came in, it's about 116. The last valuation I did to update it, I came up with a valuation of about 120. So I'd say it's fairly valued, and I have some pretty strong revenue projection. However, that will directly impact the broker-dealer model and some advisor models. Because the brokers are under the suitability standard. If their standards are changed or altered to a more strict standard, that can increase their cost. You can see more jumping ship. You're already seeing that right now. A lot of brokers are converting to either an RIA model or a hybrid model, where depending on what products they want to use in their portfolio, they can either go through the broker-dealer channel and still get paid like a broker would, or they can go through the RIA channel and get paid based on the number of assets that you manage. That's how we are compensated. At an RIA, it's based on the number of assets under management. Also, the higher client AUM minimums. There is a very large broker, which I will not name, that has increased the minimum account size for you to get paid as an advisor to $250,000. If you open an account for an investor of less than $250,000, you don't make any money as the advisor. Doesn't matter what you put them in. That has a lot of people concerned. The payout structures at a lot of the brokers are changing. They're trying to keep people on board longer. That is a weakness, I think, in that model. And you do have a lot of people leaving the brokers and joining RIAs or creating their own hybrids. RIA industry consolidation. There's a lot of roll-up firms now that are going around buying individual RIA firms. We had somebody actually approach us a little while ago. He came in under the guise of wanting to work on a client together to just try to get more information about our firm, to see what it was that we did, how much we had, what kind of investments we made. It's a pretty sneaky way to do it, but okay, that's happening. But there are, I have some numbers. I don't know them off the top of my head, so you have to excuse me here. So the research firm Sorelli Associates expects that RIAs will oversee 28% of all retail investor assets within 2 years. You're talking a significant amount of money. The number of RIA firms, there's estimated to be almost 33,000 RIA firms in the country. So it's a very fragmented market, very fragmented industry. I was shocked when I moved back to Pittsburgh from Washington, how many RIAs were actually in the area. I didn't think the area could support as many as there are, but there are a lot of smaller RIAs and they're growing. And you do have some consolidation for economies of scale. Robo-advisors. This has been a big discussion. within the industry and within our firm specifically. So how many of you have heard of Wealthfront or Betterment? Does anybody have any money with those firms? Has anybody ever tried to invest with them? So it's pretty nice, not gonna lie. It's a pretty nice model. It's cheap, it's low minimums, so that's our competitor, right? For smaller accounts, that is a big competitor for us and for everybody in the industry. This isn't just impacting RIAs. This is impacting everybody that gives investment advice. So they do have extremely low fees, and part of the issue I think in the industry that's going on is investment advice has become a commodity. It's commoditized. Anybody can get information. There is information equality across firms and across individuals as well. So it's harder to sell your services. That's, I think, one of the reasons why robo-advisors are as popular as they are. That's why Wealthfront and Betterment both have over $2 billion in assets. That's why Schwab raised $3 billion in assets in their platform in less than 9 months. That's why Vanguard has $10 to $20 billion, depending on how you look at it, in their platform that they actually have been switching clients into. So that's a big challenge, I think, is how do you differentiate yourself in an industry that the advice is viewed as a commodity. And a complexity of products and services. This is where my comment earlier about sort of almost becoming a large CFP type, where you can do everything. You can give investment advice. You could guide them towards insurance, both life insurance and long-term care. That's a big issue right now with a lot of our clients, is how are they going to pay for long-term care, as well as estate planning. We don't specifically do either estate planning or the insurance side, but we partner with groups that do. We have a couple partners in each. We work with lawyers that we can set our clients up with to be able to answer some of these questions, and we work directly with them to help the clients achieve their total goals. And actually, all of those can also be opportunities. I mean, I have them on there as challenges, but you can turn any of those into an opportunity. Schwab, for example, has their robo-advisor platform is the institutional portfolios. You might have seen their ads during March Madness. That blue box that talks to you that was on about every 15 minutes. They paid a lot of money for those ads, but they brought in a lot of assets. They have a version of that for consultants and for RIAs. We get it at zero cost. Our clients don't pay anything, and they can invest in ETFs at cost. So how do you think Schwab makes money on that? Because they don't charge us anything, and they don't charge the client anything. There's no trading fees. There's no investment fee. You just pay the cost of the ETFs. How do you think Schwab can even make money? Because they are. Trust me. Anybody have any thoughts? Yeah.
The money that's just sitting in the account, make a money market type deal?
Yeah. You're required to hold 4% in cash. No matter what, if you want to be, doesn't matter if you want to be 100% equities, you can't be. You have to hold cash. And it's their Schwab bank account. So they're making money on it because they're lending that money out. That's how they can charge nothing to us and nothing to our clients. Is it a good thing for some clients? Yeah, some clients it's actually an appropriate vehicle or appropriate tool for them to use, but it's not for everyone. We have to be very selective in who we put into that product. So I just want to throw out some tips to achieve career success that I've found over my 10 plus years. I really liked, was it Darren a couple weeks ago? No, Darren. Who was in a couple weeks ago? I watched his presentation online. Dante, yes. Sorry, Dante, if you're watching. I watched his presentation, and I liked his path. So I'm going to try, and hopefully I'm not stealing anything he said, but I thought it was really good. So challenge yourself. Don't be afraid to step outside of your comfort zone, whether that's location, geographic location, where you're going to work, what kind of company you're going to work for. Really don't just do what you're comfortable with. Really get out there and challenge it. Ask questions. This is a big one that I've found to be very important. Don't be afraid to acknowledge that you may not know something. It's not a bad thing. I've worked with people that would refuse to acknowledge that. It's really annoying, especially when you know they're not right. So just ask a question. And it's, nobody's gonna, well, somebody might laugh at you, but at the end of the day, you're gonna learn something from it and you're gonna be better off for it. Keep your bridges intact. Make an effort to make and create meaningful connections. As you move from job to job or company to company, stay in contact with those people that are meaningful connections for you and potentially could help you in your career down the road. You never know when somebody's going to call you. You never know when you might need to call on somebody. So definitely keep that in mind. And enjoy what you do. Don't forget, you need to have fun in your career. Too often you hear people are miserable in their jobs. They just don't like it anymore. If you get to that point, look for something else. Don't become miserable. Make sure that you have a good time when you go to work. It can be challenging. It can be really hard. You could work long days. At Cambridge, there were days I was there until 9 or 10 o'clock at night when I was trying to do performance, and it was very frustrating, but it was fun. So keep that in mind. So I put this on here. I just found this picture. Somebody brought it for Thanksgiving. So if you can't tell, that's me. The guy on the left, not the guy on the right. That's my grandfather. I put it up here because he's asking me something. I have no idea what it was. My mom asked him the other day. He's still alive. My mom asked him the other day, "What were you telling him? What were you asking him?" And he's like, "I don't know. That's 30-some years ago." But he's the reason I'm in investments and I'm in finance. He got the bug in me years ago to do it. He gave me my first stock and in a portfolio. He talked to me about it. He would send me the financials. As I got older, he'd send me the financials. He didn't do that when I was like 5. That'd be really weird and really frustrating for him. But that he got me interested in this space, and he's the reason why I've always wanted to do it. So I think it's important to keep that in mind too. Whenever you're going through your career, remember why you chose to do this. Remember why you're down the path you are. So if anybody wants to contact me, please do. My Gmail, that's my work email on the right-hand side. LinkedIn, definitely feel free to connect with me on LinkedIn. I don't know if you guys know, I'm sure you do. You can put your name in the URL for LinkedIn instead of having that ridiculous 15 jumbled letter, number, symbol URL. If you talk to somebody here that knows how to do that, they can set that up for you. It's professional. You can put that in your email to be able to send that out to people. But from here, any questions?
Okay. When you're getting started, what kind of qualifications or characteristics do you think made you stand out? Get that job right out of college and then just keep going into better and better positions?
Well, the one right out was it was a continuation from a summer job. The Gateway Clipper was they were very, very good to me, really. I mean, it was I worked there in the previous 2 summers, and I was interviewing with companies, financial companies, and I kept talking to companies on the sales side, and found that was not for me. I don't want to be on the phone. I don't want to be cold calling people out of a phone book. That just, the companies I was looking at, that's what I would have had to have done. And there was no base salary, it was commission. Once I finally realized that, I decided, okay, I need to sort of refocus. Went back to the Gateway Clipper, went to Mellon after that temporary job. But then after that, I think the finance background definitely helped. I didn't have an internship while I was at Behrend. I did landscaping for a couple of years. And then I worked at the Gateway Clipper, worked at Dick's Sporting Goods. That was my sales experience at Dick's Sporting Goods. Sporting Goods sell themselves. Okay, you don't need a salesperson there. You need a salesperson there if you don't know the price or where something's at or where the bathroom is. You don't need me to sell you a baseball glove. You know what you're going to come in and get. So I realized I was not good at sales. But I think really it was being able to sit across the table and talk to them, explain what it was I wanted to do, path I wanted to take. really I didn't know anything. You were commenting on my calculator. This is a dinosaur. This is what I learned to do performance measurement on at Cambridge, the HP12C. You have to do everything backwards. I don't know if anybody's actually used this. I don't know if they even make these anymore. So if I want to do 5 plus 5, if you do 5, enter 5 plus. How intuitive is that, right? So they pretty much broke down everything and taught me everything I needed to know to do performance measurement, and it was on that calculator that I learned that. And then after we learned that and were able to do it, then they let us on the computers to actually do it with the program and the software we had. So I think it was, and then from there, it was, I think it was the drive. I think it was the knowledge base that I built. I really, the stuff I learned at Cambridge, I think, was really the basis for everything that springboarded from that. Just building a solid base that I didn't necessarily have from class, but I gained it pretty early in my time. Yeah.
With the position you're currently in, with all your positions, have you felt like you've been able to maintain a good work-life balance with your work?
Yeah, no, I think so. I have 2 small kids, so everything is chaos all the time. When I was completing my MBA, I was working full time. We had a newborn, and I was going to school at night. I'd be at home at 11 o'clock. I'd work until 5 or 6, go to class, get home at 11, sleep a couple hours. But really, it was, yeah. I mean, I think everything I've done. I mean, even I said at Cambridge I'd work some nights until 9 or 10. It wasn't every night. There's some long days, but I think the work-life balance, you have to make it work. You have to work hard sometimes to make your work-life balance work, especially now. I travel some for work. It's mostly maybe 1 or 2 night trips to New York to meet with managers, more local, maybe Chicago. So I'm not gone very often, so that helps, but you have to work at it. It's not something that just comes easy.
So you found value in really having these HP before you just went straight to computer program.
Yeah.
So for all the students who say, just let me use the Excel spreadsheet. When I make you do it by hand, there is that.
No, every person, we sat in a classroom for a couple weeks before they let us anywhere near our desks, and they taught us performance measurement calculations by hand first, easier numbers, and then nothing but the calculator. And yeah, I can't say enough how much that base I think really strengthened my skill set. It was challenging, but it was well worth it.
Any other questions?
Well, thank you very much for coming. We really appreciate it. All right. Does anyone else have any questions? Anything for the FMA, for the current officer team? Because after this meeting, we're pretty much passing it over to the new guys. So, anyone have anything?
If you haven't signed this yet, I'll keep this up in front.
I think we should offer a round of applause to the outgoing FMA officers. They've had a phenomenal year, so.
All right. Well, thank you everyone for coming. Hopefully, we'll see most of you at the holiday party next week. Have a great night.